Hi folks, welcome to RJ Impact. Following up the video I did on FTX, FTT, Alameda Research, Bankman-Fried and the debacle that surrounded the collapse of the aforementioned, he's actually now done a couple of post-collapse interviews. I thought it would be useful to juxtapose his interviews as FTX grew and he was lauded by all and sundry to the post-demise interviews he's done in the last couple of days. A sort of compare and contrast, if you like, to see what clues we can gain in hindsight and what we can learn, if anything, about the catastrophe that is FTX. If there was a before collapse, BC, to this story, then we might call these post-collapse interviews AD, after demise. Let's take a look. BC. Here he is talking to Forbes about his background before FTX.
Brief backstory, I went to MIT, had a good time there, though I guess I learned that I didn't want to go into academia. Worked on Wall Street for about 3.5 years after that at Jane Street Capital. Really enjoyed it there. Got into crypto in 2017 and started up FTX a year later.
As you can see, he comes across as a slightly gawkish, sort of nerdy character. When he set up FTX, in his own words, he didn't give it much of a chance of succeeding.
When we started building FTX, I thought there was a 20% chance that we would ever succeed in getting customers. I had no idea how to market or build a brand, and I was the most optimistic on the team. Other people were lower, but it just seemed like such a compelling opportunity, such a big opportunity, that it was worth trying, even though we didn't think the odds were very high of success.
Now, in the light of the catastrophe that FTX has just undergone, and the corporate failures that were apparently inherent within FTX, not just its financial demise, but the people that got sucked in and lost their life savings, in some instances his comments here about doing the right thing are ironic at best, hypocritical possibly, but downright Machiavellian and devious at worst.
My job is to make sure that we do the right things at the end of the day, one way or another.
One of the things he did post to all and sundry about himself was his belief in effective altruism. I believe that he said at some point he'd be giving most of his wealth away. Now, it's unclear exactly what assets or wealth he does have at the moment, talking AD here, but he is articulating that belief. Notably, he doesn't talk about taking other people's wealth and doing with that as he sees fit.
I'm part of an effective altruism community. Basically, it's a group of people looking to try and figure out, if you want to maximize the amount of good you do, maximize the positive impact that you can have on the world, what does that imply? What does that mean you should do with your life? And I think it sort of grew out of like, here's a group of charities, you're going to donate $100, which will save the most lives, right?
Also, on effective altruism, here Matt Levine puts an extremely harsh way of looking at his charitable claims. Note that he doesn't exactly deny the way Matt describes the process.
I want to just quickly ask about effective altruism. Like one model for your kind of like utilitarian calculus is that that a lot of people want to gamble. Crypto is both a good sector for gambling and a very efficient way to extract fees from gamblers if you run a crypto exchange. And you are sort of in the business of funneling money from people who are going to use it poorly on gambling to like animal charities and pandemic preparedness and Joe Biden. Is that too cynical of you, or is that not cynical at all, or what?
I think it is too cynical. I think this is also something I've gotten more appreciation for over time. I think I sort of like had much more unformed thoughts of this earlier in my life, but you know, I think I've increasingly come of the view that like it is, at the very least, I want to be doing something net positive.
The media, though, just couldn't get enough of him, gushing with every interview.
They call him the JP Morgan of crypto, right?
Yeah, the Michael Jordan of crypto, if you will.
On starting up in business, here he is explaining how and why he set up Alameda Research and the basics of the arbitrage that it was doing in the crypto world.
All right, so you started your own company. What was it called?
So Alameda Research is the first company I started up, and it was a crypto quant trading firm. And you know, the sort of founding of it was basically, well, Bitcoin was trading on a lot of different crypto exchanges, and it was not trading at the same price on all of them. So you might see it trading for $10,000 on Coinbase and $10,100 on Bitstamp. And, in theory, there's a 1% arbitrage to do there, trading those against each other.
And then he went on to set up FTX, and again here he is explaining how and why he set up FTX and what it was doing in the crypto world.
Now, what does FTX do that your first company didn't do?
FTX, you can think of it as infrastructure. It's markets infrastructure, so everything that sits between a buyer and a seller. So FTX doesn't buy and sell itself, but it's a venue where people can go to trade crypto, and that aims to solve sort of every piece in between those two parties, from the clearing and settlement and custody, the anti-money laundering, know your customer policies, the compliance, the matching engine, the risk engine, the front end, and everything else.
Now, in the lead up to its demise, FTX had been purchasing struggling companies and was seen as a bit of a hero on that front, preventing contagion from spreading, as Sam Bankman-Fried puts it, in the ecosystem. Now, he explains this further, but catch his last words here. The standard was, do as we feel, okay? Well, lack of due diligence is staring you right in the face here. We're going to pile our investors' money into this failing company because we feel okay. Not good enough, Sam Bankman-Fried.
At his role as the industry's lender of last resort.
We only had a few days to make some of these decisions. What we basically came to believe was the following. The first was that, if possible, it would be extremely valuable to the ecosystem to backstop some of these places. First of all, just backstopping customers and making sure they're protected. But second of all, stopping contagion from spreading through the ecosystem, right? Stopping it from being the case that anyone who transitively did business with any chain of people who did business with one of the troubled assets themselves became troubled. And then the secondary goal was maybe there are good trades to do. Maybe there's an investment or acquisition that can be done at, terms that we'd be excited about, given the sort of need for capital right now. But that was usually not the standard we were able to hold ourselves to. In practice, the standard was, do we feel okay?
About his work schedule, he says that he doesn't have a regimented set of meetings nor daily schedule. So, for example, he didn't have daily meetings on liquidity, essentially saying, not important, if nothing is going on. Now, in hindsight, I think you and I would agree and suggest to him he's damn wrong on that one.
And if you have your, daily call about, exchange liquidity and there's nothing going on with exchange liquidity, you're just going to waste that hour, right? And meanwhile, there's some fire burning somewhere that you have to be attending to.
On his wealth and how that impacts him, he plays this very much down. He was based in the Bahamas, as we know, and for example drove a Toyota Corolla to and from work. Here he is on that front, talking a little bit about his lifestyle. He does fail to mention the word polycule here, of course.
Your outfit is pretty much standard. It's some kind of t-shirt, shorts, tennis shoes. Is that what you wear all the time?
When I go to Washington, D.C., I have a suit there because I have to wear it on the Hill. But outside of that, yeah.
So are you thinking of buying a house to live in, or where do you live?
I live in nine colleagues and I bought a large apartment together near our office that we live in. And I'm sort of really fortunate to be able to have a really comfortable life and not have to worry ever about, money for myself. But I'm not particularly excited to dive into luxury. I'm not excited about yachts.
Well, one of the points he makes about his burning issue is that of regulation. Here he is talking about just that. Now, one of the points that has been made about him was that he was very keen on regulation for everybody and every other company, rather than himself and FTX. The fact is, though, that a robust regulatory regime might have saved a lot of people and a lot of companies essentially everything. It's interesting that he puts this in amongst a jumble of things making up his working day. Seems that he puts this most important thing to him in a very weird context.
But what are sort of some of the jumble of things that, that really play a significant role in my schedule these days? Number one is regulation and licensing. That is the most important thing for our business. It's the most important thing for the industry right now.
I couldn't get by this update without mentioning League of Legends.
I don't have a lot of time for hobbies. I play some League of Legends quite badly. I watch way too much sports in the background.
For the uninitiated, League of Legends, commonly referred to as League, is a 2009 multiplayer online battle arena video game developed and published by Riot Games, where 2 teams of 5 players battle in a player versus player combat. Enough said. One of the stories about Sam Bankman-Fried is that on one conference call where potential investors looking to put in millions or hundreds of millions of dollars into FTX saw him essentially playing League of Legends during the call. Not that interested apparently in the call. Well, the story goes that the investors saw this as some kind of quirky foible of an eccentric genius who was going to make them a fortune. In my opinion anyway, if it looks like a duck and walks like a duck, well, you get to the picture. Here he is talking about the fact that FTX bought out a number of failing companies. One of the reasons he cites for bailing them out is that he might just prevent those companies from dipping into customer funds to pay the company's payroll. Well, given the missing company funds in FTX, AD, the levity in which this answer is given, and to be fair commented on by Matt Levine, is truly astounding.
Well, okay, the best case is that I have tons of extra capital, but then why are they calling us? So, okay, of the calls we might get, the best case is when they have about 0 left, right? And, you know, they're like, look, we need a buffer here so that we can, like, definitely pay salaries without dipping into customer funds, like, you know, and we're like, that makes sense, right? And in those cases, like, what we would tend to do is, like, okay.
Because otherwise they would.
Well, depending on the company, right? Otherwise maybe they would declare bankruptcy, or maybe they would dip into customer, whatever. There's a lot of unpleasant choices there, right?
Leverage. I'm going to take a deep breath here because to understand FTX fully, you do need to understand leverage at least to some extent. So I'll give it my 2 cents and try to describe, at a high level anyway, how it works. Leverage is actually prevalent in the cryptocurrency marketplace, and exchanges like FTX allow customers to trade with leverage. Without going into huge detail, I'll give you a sense of why leverage is risky, not just for the retail customer, but the exchange itself. Leverage in one basic sense is a way to buy a position in more crypto assets than your money could purchase if you just bought the assets outright. So let's take an example. Let's say you have $1 and you purchase $1 worth of cryptocurrency, Ether for example. If the Ether rises in value by 5% and then you sell it, you'll have made a 5% gain or 5 cents. If you leveraged your dollar at 20 times though, you will effectively have that $20 stake in Ether. So if the price goes up by 5%, your $20 becomes $21 and you'll have made $1. In other words, your original $1 has become $2 and you have just doubled your money, or made a 100% return. On the other hand, if the price drops by 5%, then you lose $1, or your whole investment. Now, the problem then lies in what happens if the price drops by more than 5% and you lose more than your original dollar. Those losses must have come from somewhere, and firms have several ways of dealing with this. Primarily, they can either cancel the trade when your original dollar has been lost, often called a stop loss, and stop the trade there, or they can require you to post what is called margin, and that is essentially the amount of money needed to cover your losses. However, what if you can't pay the margin? Who picks up the bill if you can't pay? Well, this is the nub of the matter, and this becomes the problem of the exchange. In FTX's world, this dollar was billions. Now, the reason for that long-winded explanation is to restate a point I made in my previous video, and that is that FTX allowed one of its customers, that is Alameda Research, to trade without any stop loss. This is a sister company of FTX, essentially owned by Sam Bankman-Fried, and we know that it was incurring losses on its leverage trades. This shows a real lack of risk management on behalf of FTX and was picked up by the liquidator of FTX after the fact. So with that very long preamble, a very short clip to show that Sam Bankman-Fried did indeed understand the issues surrounding leverage and the risk management regime that needs to be put in place. Yet, as we understand things, he let this continue in FTX regardless.
The fact that no one was like, 20 to 1, huh?
Well, so the institutional players don't necessarily see their whole book, right? Like they don't necessarily know if most of their loans were over collateralized or not at all collateralized. And I mean, separately, I think there are like hard risk management questions that a lot of these platforms would need to ask themselves, even in the case where they're fully made it through this event. Right. But like that's that's step 2, and step 1 is like stabilize, and step 2 is like think about whether this business model and this implementation of it made sense in the first place.
Perhaps you're wondering why Caroline Ellison, you know, the one he is supposed to have had a romantic relationship with and was the CEO of Alameda Research, hasn't appeared in any of these BC interviews? Well, so am I. We might hear more about her AD. AD, after demise. So, Sam Bankman-Fried has provided a couple of interviews in the past few days addressing the issues that surrounded the demise of FTX, his role in it, and the wider contagion that happened in the crypto space. Let's unpick a few elements of these and see how his BC worldview contradicts or collides with his AD worldview. Just for context, with the demise of FTX, Bitcoin fell to its lowest level in 2 years. BlockFi, one of the companies that FTX bailed out, filed for bankruptcy, and generally a widespread fall in all crypto assets and associated companies ensued. Sam Bankman-Fried, the wanted man. These clips are from an interview with the New York Times, and Andrew Sorkin here does not beat around the bush with his first questions, mistakes and bad decisions or fraud.
The generous view, and the generous view is that you are a young man who made a series of terrible, terrible, very, very bad decisions. The less generous view is that you have committed a massive fraud, that this is a Ponzi scheme, a manipulation of the system.
I made a lot of mistakes or things I would give anything to be able to do over again. I didn't ever try to commit fraud on anyone.
So, a flat denial of fraud. Who'd expect anything else, of course? Sam Bankman-Fried got into some detail about the specifics that led to FTX's demise. Very awkward was when Sorkin puts to him details from letters he's received from investors who've lost their life savings.
Can you please ask SBF why he decided to steal my life savings? And the $10 billion more from customers to give to his hedge fund, Alameda. Can you ask him why his hedge fund was leveraging long all of these S coins? I'm going to keep it polite for the kids. Please ask him if he thinks what happened was fraud.
Yeah. I mean, I'm deeply sorry about what happened. Here's, the long and short of what happened. And I'll start by saying, just to make a distinction here, you look at the US platform, you look at the international platform. The US platform is a US regulated platform with American users. To my knowledge, that's fully solvent, that's fully funded. And, I believe that withdrawals could be opened up today and everyone could be made whole from that none of these problems plagued the US platform.
It's very interesting to me, this distinction that Sam Bankman-Fried makes between the US and the non-US platform. My guess here is that the US platform had more regulatory controls over customers' deposits than the non-US platforms. Which does beg the question, if Sam Bankman-Fried was so keen on regulation to protect the industry, why did he not apply the same controls over the whole of his business that apparently were over the US part of the business? And that should be regardless of the regulatory regime. Operating two standards across his empire did not inspire confidence, in my opinion. In respect of the relationship between Alameda Research and FTX, he talks about the position Alameda had with FTX.
Alameda Research did have a long position. As I try and reconstruct this, over the last month, I have limited access to data, but my view of it, from what I have been able to see, is roughly that, basically, look, a year ago, Alameda had, I think, something like 10% leverage, had something like 10 times the assets of the position that it had on. Over the course of the last year, there were a number of market crashes that drove the value of those assets down and the leverage up. I think it was, to my knowledge, still under 2x leverage, as of a month ago.
Okay, so I've spoken a little bit about leverage, and Sam Bankman-Fried says that a year ago, Alameda had 10% leverage. In broad terms, that means that Alameda Research could lose 10 times its positions before it ran out of money. He then switches terms and says that a month ago, Alameda had a 2x, or 2 times leverage. That essentially means a 200% leverage, which sounds and should be alarming. Essentially, that means that FTX had let Alameda bet, and I'll call it bet, double the amount of assets it had. And my understanding is that this had no default stop loss. In other words, if Alameda did lose money, and we know it did, then it wouldn't be able to pay, and FTX would be left to cover the losses. I'll note that he didn't really answer the question, and some of his answer is somewhat rambling. He points to the wider marketplace collapsing, and I guess he's hinting, although he doesn't say directly, that this was an exceptional situation and outside his reasonable control. One of the clauses in the terms of service that FTX had with its customers has been getting attention in recent days, and this is in relation to the commingling of funds. This is addressed by Sorkin, and he reads that out before posing the question, essentially, why could Alameda do this?
It says, none of the digital assets in your account are the property of, or shall or may be loaned to, FTX Trading. FTX Trading does not represent or treat digital assets in users' accounts as belonging to FTX Trading. So how is it possible that Alameda had this loan of such a large size?
FTX could, if it needed to, margin call those positions and close them down in time such that it would cover all of those, all those shorts, all those liabilities. Obviously, that wasn't the case here, and that's a massive failure of oversight, of risk management, and of diffusion of responsibility from myself running FTX.
I don't think that Sam Bankman-Fried really truly got to the heart of what might have happened to retail investors' funds, except for saying that in their own positions, FTX could have margin called the retailer's assets, essentially to protect FTX. But apparently not for Alameda. So that's a failure of risk management, he says, and also of him as a CEO. I think we might be near the heart of the fraud allegation that might surround FTX at this point. To what extent was he bending risk management protocols to allow Alameda a potential advantage that he wouldn't allow other investors, and to what extent was this deliberate, and to what extent oversight? Surely he's just admitted knowledge of it. Can he therefore claim oversight as an excuse? I'll let you dwell on that one. He reiterated that he wasn't trying to commingle funds and it might have been oversight. A lot of things he seemed to have missed so far, don't you think? Remember Caroline Ellison? Well, she definitely knew about the commingling. Let's hear what she told her staff.
The Caroline Ellison told Alameda staffers that Alameda used FTX client funds to cover loans that were being recalled because of the Luna-triggered credit crunch. Caroline says that she, Sam, Gary were aware of this. Yet it seems like Alameda people we're living in the same penthouse where you may very well be right now, all together.
Most of Alameda was not there. I don't live there now, but or not there now. I have not lived there for much of the time. But I did live with one or two members of Alameda for a little while.
Now, Sam Bankman-Fried, BC, had told Bloomberg that Alameda was a separate company and he was making the broad point that it was independent and he didn't know what was going on there. Well, get this point. Look how uncomfortable he is answering this and making out, it was only a couple of people, I'm not there anymore. Definitely evasive on that point. He puts it down to another mistake. Again on the commingling of funds, this one was definitely an evasive answer.
When did the commingling of assets begin?
So, and again, lots of traders had open margin positions on FTX where they would have borrows of assets where they would be short some asset against, against other assets as collateral. That being said, again, looking through this now, I think that position size for Alameda got substantially larger over the course of 2022, and that it was, I think, substantially larger by October of 2022, probably by July of 2022 than it had been in April.
What he is saying does not address the question at all. In my opinion, there is a strong possibility that all of this had been going on since FTX started. So why is he even speaking right now, given the real potential he has for criminal and/or civil proceedings, where all of these interviews will clearly be picked over by teams of lawyers?
What are your lawyers telling you right now? Are they suggesting this is a good idea for you to be speaking?
I don't know, really, and your guess is as good as mine. Do you remember the suspicious transfer of crypto assets that took place just after the bankruptcy filings? Well, a flat denial of knowledge by Sam Bankman-Fried on that one.
$515 million was suspiciously, in quote, transferred from FTX wallets after the bankruptcy filing.
Some actually improper access of assets on the exchange. Right. And I don't know the details of that. I don't have the resources to trace through exactly what happened there. And I don't know who is behind that third part.
On a slightly different tack here, are there suspicions that Sam Bankman-Fried actually used the company's funds, FTX's that is, to some extent as his own, and blur the distinction between his personal and the company's assets? I'm not too sure. Here he is talking about a home that the company seemed to have bought that ended up being a vacation home for his parents.
Can you explain the real estate piece of this to us? I think there's been a number of headlines, as you know, about FTX, the company, buying a lot of real estate up in the Bahamas, where you lived, at least at the time, was owned by the company. But then there's also reports that your parents signed and were effectively provided with what seemed like a vacation home.
So I don't know the details of that house for my parents, but I know that it was not intended to be their long-term property. I know it was intended to be the company's property. I don't know how that was papered, and I think that was where it was and will end up. I think they may have stayed there while working, with the company sometime over the last year.
Did he answer that question? I'm not so sure he did. Drugs. What about the uppers and downers and wild parties? Well, he certainly played this one down. Perhaps there'll be more in due course about this, but he's really not giving anything up on that front.
Can I ask you about the drugs? You have tweeted about it. Caroline has tweeted about it. Others have tweeted about uppers and downers and all sorts of things. There have been pictures taken of something called MSAM, which apparently increases levels of dopamine to the brain. It's actually for Parkinson's. Were you taking that as a patch?
I can say for me, I don't know, like I've been prescribed various things at various times to help with focus and concentration. There were no wild parties here. When we had parties, we'd play board games.
And finally, the question a lot of people have been asking.
Sam, how much money do you have left at this point?
I mean, to my knowledge, like close to nothing. I mean, basically everything was just in the companies. I mean, it's.
You didn't put away some money somewhere?
No, I don't have any hidden funds here. Everything I have, I'm disclosing, and I'm down to I think I have one working credit card left. I think it might be $100,000 or something like that.
So that's it. What have we learned? Well, I think there's enough in this for me to say that Sam is going to have a very hard time stating that he didn't know about the size and the scale of Alameda's operation within FTX and the risk to FTX. This knowledge is going to be a very key element, obviously, of any fraud allegations that end up becoming criminal filings. And also, in my opinion, I think he was given quite an easy time here, and there were a few hard follow-up questions, particularly when he avoided the question entirely. I mentioned earlier that there were a couple of interviews, and the channel CoffeeZilla has done an excellent second interview with Sam Bankman-Fried. This was not as easy as this interview, and Sam Bankman-Fried was given quite a hard time when he obfuscates answers to questions with very pointed follow-up questions. And Caroline Ellison, well, she's lying low and not much is known about her whereabouts and current status. I hope you liked this content, and if you did, a like and subscription is greatly appreciated by the author. Thank you very much. So let's see what further developments unfold as time progresses. I'll be keeping an eye out. Bye for now.